My name's Alex Perney. I've been with Advanta since 2012. Currently, I work in our business development department, and I've been doing that for about the past 3 or 4 years. But I started with Advanta doing actual transactions for clients. I've done well over 1,000 individual transactions, whether it's being real estate, Roth conversions, you name it, I've had some experience in it. So I like to help impart that knowledge to people that are interested in our service. So if you have any questions, I do encourage you to either email, call me, or you can type them into the chat box right here. I am happy to answer the questions posed there as well. All right, looks like we got everything working. So today we're going to be covering Roth conversions. It's getting towards the end of the year, and if you would like to move the funds from a Roth account to a traditional tax deferred account to a Roth account, you do have some looming deadlines. So we'd like to make sure people are well aware of that and educated on what their options are. Now, before we get really too far deeper into this, Advanta IRA and our employees, we do not provide investment advice, nor do we endorse or promote any investment products. All information and materials are for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of financial investment. So I always like to make sure that I give a little bit of a history lesson of Roth IRAs and their history, because they had not been around for nearly as long as traditional IRAs. So the traditional IRA was created in 1974 under the Title II of the ERISA Act, which created IRAs and 401ks. Now, it wasn't until 1997 that you have the ability of people to start contributing to retirement plans post-tax, not pre-tax, meaning that you have already paid taxes, you are now contributing into those plans, and you are allowed to grow your funds completely tax-free. And once you reach the age of retirement, then you get to enjoy those great tax benefits of tax and penalty-free distributions on the entirety of the account, including your earnings. And as of 2006, Roth 401ks are allowed as well, and also the ability to do conversions in plan of Roth 401ks is available too. So if you have a traditional IRA, or if you have a traditional 401k, maybe a solo 401k, or even a SEP IRA, all of those different types of accounts can be converted into a Roth. And we'll get into the specifics of what it actually means to convert to a Roth with regard to tax reporting and the tax liabilities here in a minute. But just want to give a brief history overview of when these things were written into law, and so you understand where this is coming from. So we got a question. Sure, go ahead and just advance the slide, and then I will answer that for you. So, any recommendations on how to determine an end-of-year valuation for the IRS on a syndicated investment, apartment buildings, that was invested in 2020? The purpose is to convert from traditional to Roth effective 1/1/2021, as the individual's W-2 income will drop by a third in 2021. And the syndicator is not being super responsive. Good question. So you have a few different ways that you can frame this. Essentially, what he's asking is that when he wants to do a Roth conversion, meaning moving funds or assets from a traditional type plan, so a tax deferred plan, to a tax-free plan like a Roth. Now, with cash, it's easy to determine the value of how much you are going to be claiming as additional income in a given year. It's just dollar for dollar. When you have an investment, it gets to be slightly more cumbersome of a process. Now, unfortunately, there's not one specific answer I can point this individual to. It's with kind of irregard of the investment provider being cooperative. It's really not their business to assist with this portion of it, because excuse me, you do have to have a clear and independent third party evaluate your asset. Now, who can that be? Typically, it's going to be someone like a tax advisor or a CPA. There are valuation service providers in the US that specialize in valuating assets. The actual investment provider would not be the one to be able to provide you with the actual value. Now, with things like syndications, when there's more or less going to be one singular asset that is tied to that particular entity. So in this case, a apartment complex, it's, most of the time the syndication is set up to have a singular asset, or there might be multiple ones, but what we're looking at is a valuation of the actual partnership shares, the LLC units, whatever it is you actually do hold, the evaluator would need to sign off on. And typically, most clients utilize either an attorney that specializes in that particular type of law. So in this case, it might be a private securities attorney or a qualified tax advisor. But they would need to be the ones that help you levy the valuation and act as the clear independent third party for that. So we'll get a little bit more into that a little bit later on, but I think that kind of answers Dave's question with regards to specifics on that one. So IRAs at a glance. So anyone with earned income is eligible to contribute to a IRA, and this is Roth or traditional. But your deductibility is going to be based on your annual income for tax deferred plans. Now, the benefit of a traditional IRA is you get a tax deduction, lowers your current tax bill, so long as you don't make too much money and you have to then in turn make it as a non-deductible IRA contribution. You enjoy tax deferred growth, and any form of 401k or 403b, governmental 457 thrift savings plans, they can all be rolled into traditional IRAs with no tax penalty, and it helps you grow your retirement savings. But now keep in mind that you can still do all of this stuff through a Roth IRA. You're just not getting the tax deduction that you would be in a traditional IRA. So that's the real big thing to look at with regards to which one's going to make the most sense for you. And in the context of Roth IRAs, if you're a higher wage earner, it's probably going to make more sense just to do a traditional IRA contribution and convert it over to a Roth IRA. Some people like to call that a Roth conversion, or sorry, some people like to call that a backdoor Roth conversion. I'm not the biggest fan of that because it is a completely above board way to do things. And if you're already not getting a deduction for your IRA contributions to a traditional, which is explained right here, is that if you are making certain amounts of money, you're not getting a deduction for your traditional IRA anyway, so might as well move it to a Roth. So if you're a single active participant, then you get a deduction phased out at $65,000 to $75,000. If you are married filing jointly, then it's 104 to 124,000. If you are filing a separate married tax return, if you make more than $10,000, you cannot take a deduction for traditional IRA contributions. And then the spouse of an active 401k plan participant, adjusted gross incomes for the household are 196 to 206. You do not automatically get a deduction for traditional IRA contributions. And the reason I bring this up is that the mechanism for moving funds from a traditional to a Roth, if you make too much money for the Roth and don't get a deduction for the traditional, is the Roth conversion. So it's important to understand that Roth conversions are not just something to look at from the perspective of, hey, I already have this money in a traditional IRA, just want to move it into a Roth IRA, or I have an asset I'd like to move. You also may have other opportunities to get money into a Roth if you're not afforded the benefit of deductibility under a tax deferred plan, such as a traditional IRA or a SEP IRA as well. Okay, since we're done with that slide, we get another question. Bill asks, do I need to have earned income, W-2 earned income to contribute to an IRA? What about the Roth IRA? I do not exceed income level limits. So in order to make a direct contribution to a traditional IRA or a Roth IRA, if you just want to put money directly into one, you have to have earned income that is going to be shown not necessarily on a W-2, but income that you are paying um, like FICA tax on, income that you are having Social Security and Medicare deducted from, what is typically classified as ordinary earned income. So it can't be dividend payments, it can't be royalty payments. It has to be something that is from an active earned income standpoint. Typically, it's going to be filed on Schedule C, but there are other schedules that can qualify your income for making contributions directly to an IRA. Okay. Phil, your question was a little bit cut off there. I see you have a 1 and a 2, but the second portion didn't come through. So go ahead and finish typing that in, and I will get to that. But let's go ahead and move forward with this. We got a few questions popping. I'll cover it in a slide or two. So what are the points of utilizing the Roth? Well, to exemplify that, I'm going to show you what a traditional IRA looks like, which might help you to make your decision on wanting to move into a Roth. So if you want to take money out of a traditional IRA, you have a 10% early withdrawal penalty and excise tax of 10% if you're under 59 and a half. Everything that you take out of the IRA for a traditional IRA is taxed at ordinary income. And at the age of 72, you have required minimum distributions that have to be taken out every single year. But however, for Roths do not have a required minimum distribution. One thing to keep in mind, though, is that some of the proposed tax legislations that are coming out are proposing to raise the required minimum distribution age up to 75, I believe, but currently it still is 72. If anyone has seen that, it has not been passed yet. So currently the required minimum distribution age starting date, or the age of requirement, is 72, the year in which you turn 72. And then you do have some exemptions for getting rid of the 10% penalty, but it's not as flexible as the Roth. And then also, it does not matter if it's a traditional Roth IRA or a Roth inherited IRA, you still have all the same rules applying to those as well. Okay, got a couple questions filing in before we start getting into the real nuts and bolts of the Roth. Let's scroll up. Let's see, Nathan asks, I have a W-2 with income over traditional IRA limits. The two ways which I am aware of putting money on a Roth is the backdoor Roth IRA and post-tax 401k contributions, which I can shift to a Roth IRA. No, I mean, those are really your ways to get money into a Roth IRA. You can convert as much as you want from a Roth or from a traditional IRA plan to a Roth IRA. There's no limit on that. But as far as just putting money into a Roth IRA, you are able to certainly do that. Now you can contribute to a Roth 401k if you have the provision for that. Your $19,500 deferral of income deferral, depending on your age. If you're over 50 and a half, you get an additional $6,000. You can all do post-tax to a 401k, and there's no applicable phase out for that with regard to income. But it just really kind of depends on what you have. There's not a ton of ways to convert into a Roth or get money into a Roth. So the two that you mentioned are relatively kind of the par ways that people do it. But it's depending on your situation. We can certainly look at that more in depth. I'm always happy to have that conversation. If you want to give me a call directly or shoot me an email, I can certainly take a look at that. But you're kind of right on the point there. Let's see. As Donald asks, can earned income be passed through income from an S corp reported on K1? No, typically not. Earned income for the purposes of showing it for an IRA contribution typically is not going to be something that you are going to show on K1 unless you are the main like limited partnership, the limited partner or something for an entity in which you are paid out on a K1 for being a shareholder, but also are performing active duties for that entity. That's really something better suited for a tax advisor. It's something that there's a lot of kind of check this box but not that box and what ifs that would specifically go towards being able to qualify a Roth contribution when you're talking about S corp income, and especially if you're talking about something being paid on Schedule K1 form. K1 as well. Let's see, does the higher education expense exception apply to you and your immediate family? It is the Roth IRA holder, so it would be for paying for your qualifying higher education expenses. It's not necessarily for your family. So the big thing with that is that you establish a Roth IRA for your children, and then they could take out the penalty-free distribution, or they could take out basis to pay for higher education expenses. With traditional IRAs, you get exempted from that, but you are still paying taxes. Let's see, we'll be going over how to calculate the amount of taxable amount we have non-tax IRAs. I mean, not necessarily, because everyone's tax rate is different. I'll show you, what you are claiming in taxes and the restriction for doing that and some other numbers, but I can't necessarily calculate what anyone would pay in taxes because I have no idea what everyone's effective tax rate is. But at the end of the day, it's going to be a increase to your modified adjusted gross income at the end of the year. So you get a form 1099 for whatever you took as a distribution from the traditional IRA or traditional 401k and put into a Roth. You'll just get a 1099 for that with a known exception, meaning that even if you're under the age of 59 and a half, that will the exemption code will show that everything going in there is due to a Roth conversion, and you are only paying ordinary taxes on it. There's no other type of basis tracking for like short or long-term capital gains. It's just a block of income that you show in that given year, and then your effective tax rate will determine how much tax you are liable for in that year. Yes, Preton, we'll get into that in the next slide with regard to figures. There is no restriction for holding multiple IRA accounts. So with regard to, this is a good one. So for required minimum distributions, if you turn 72 in the year of 21, you can defer it into the next year, but you have to take both distributions in that year. So it's kind of one of those things where you're kind of better off taking it in 1 year as opposed to having a lot more income, unless you know you're going to have large credits and deductions in which the year in which you are taking it. Cheryl, what about 1099 from a partnership? No. All right, and that answers those questions. So once we get another pile of them in, we'll go ahead and get through those as well. So Roth IRAs. Anyone with earned income who does not exceed income limits, you are eligible to contribute. That means just taking money out of your pocket and putting it directly into the plan. Does not have anything to do with Roth conversions. Your Roth conversions are never going to be capped or eliminated because of how much money you earn. You are always able to do a Roth conversion from deductible basis plans to tax-free plans such as a Roth. Tax-free earnings and no taxation on withdrawals so long as they are over the age of 59 and a half and the account's been open for 5 years. There's no mandatory withdrawals, and the low taxable situations that most people are enjoying presently, with one thing historically that we have seen is that taxes do continue to rise over time. So your modified adjusted gross income phase out rates for utilizing a Roth IRA. Now, this was asked by a few people. So if you make over these certain amounts of money, you can't just take money out of your own personal paycheck and put it into a Roth IRA. That has nothing to do with Roth conversions. And that's a big thing that most people get hung up on, is they think, hey, I can't have a Roth because I make too much money. You can make $1 million of earned income in a given year and still be able to contribute to a Roth. And it is completely legal to do. You just would have to make that contribution to a traditional IRA and then convert it over to a Roth. You wouldn't be getting any deductions, and there'd be some additional tax filing, but again, you can always do it. Now, the phase out limitations: if you're a single individual making $124,000 to $139,000, then you are phased out from directly contributing to a Roth IRA. If you are filing a joint tax return and you are married, if the household is making $196,000 to $206,000, you cannot directly contribute to a Roth IRA. And then if you're married filing separately, you have a 0 to 10,000 is going to be your phase out range. So again, if you are making more as either a household or an individual, per the figures on the slide, you cannot directly just put money into a Roth IRA. You have to then in turn first contribute to a traditional, and then convert it to a Roth. And you can always do conversions of existing tax deferred assets as well. So what exactly is a conversion? So a conversion is taking an account with pre-tax contributions and earnings. So you don't necessarily have to only look at your basis of contributions or just your earnings. When you do a conversion, you look at it as a holistic pool of assets. You don't necessarily have to break things out and say, hey, here are the net earnings attributable to this contribution for this year, and here's net earnings attributable for that. So then I can only convert the difference, or I have to do a prorated conversion. It's as much or as little as you want from that without having to worry about tracking of any of those different pools of funds. Now, typically this is done from a traditional IRA, but you can also convert SEP IRAs, simple IRAs, old 401ks, existing 401ks if your plan has a, excuse me, has a provision for allowing in-plan Roth conversions. You are allowed to do that as well. And then some strategies that some people will use is that if they have a SEP IRA and it makes a lot of sense for them to be contributing to a Roth IRA, you can take a SEP IRA contribution and immediately convert it to a Roth IRA. If they have an existing SEP or they can't change that type of plan or they enjoy some aspects of it, they can take those high contribution limits that they have for that SEP IRA and convert them after making the contribution. Essentially, and what a conversion really is that you are transferring those funds into a post-tax account. You're electing to pay the taxes presently and on the funds that you are transferring over. You don't have to necessarily look at anything else other than what you are moving over. So there's no additional taxes that you'd have to pay. It's just on the amount of money. So if you move $7,000 or $700,000 from a traditional to a Roth IRA, that is going to determine exactly what the 1099 is going to show for how much tax liability you are going to take in that given year. Now here's for some of the rules, and these are really important for the upcoming years. Now, essentially, if you want to have anything counted on this given taxable year, so for your 2020 tax return, you have to do your conversion by December 31st. So essentially, the clock is ticking. We have 29 and a half days, or we have 30 and a half days left for you to be able to do that and have it counted on this year's tax bill. You cannot do a conversion of assets up until your filing deadline. And there's no adjusted gross income for converting to a Roth IRA. Now, keep in mind that this is where it gets a little bit tricky, especially for clients that are invested in self-directed assets, because when you're just doing cash, it's a dollar for dollar conversion. If anyone's ever done a conversion at a brokerage and they just converted stock, it's whatever that stock trading price is at that window in time during that day. Now, how do we get valuations for things that are a little bit more alternative, things like real estate, things like private placements? Well, if you have real estate, you would have to get a certified appraisal, not just a taxable valuation, not a comparative market analysis. You'd have to provide a certified appraisal plus a deed in order to move that property from a traditional IRA to a Roth IRA. And you can do this over 2 years. You can do a portion of it in December and then follow up and do another portion in January to help mitigate your taxable liability. Because keep in mind, whatever you convert in that given year is counted on that year. But since we're at the end of the year, it gives you a very unique opportunity to split your taxable liability across 2 tax years while still accomplishing something within the span of, let's say, a week. If I think New Year's Day is on a Thursday or a Wednesday this year, so you could have a portion of it done on Tuesday and then the rest on Friday, and then essentially from the IRS's eyes have split taxable income over 2 full different years while still accomplishing what you wanted to within the span of a week. Now, if your adjusted gross income is too high to contribute to a Roth IRA, this is also where you can make your contributions and then convert it from a traditional IRA to a Roth IRA. All right, we'll get into the rules in a second since we've got some of the basis of that. Let's answer a few questions. Oh, whoops. Let's see. Camille asks, I want to be able to create a Roth IRA for my daughter. However, I understand that she must have earned income. Does babysitting count? How does she record babysitting for tax reporting purposes? It actually absolutely counts. She just needs to file taxes on it. She would, file as a self-employed individual or independent. Get with your tax advisor; they can help you out with that. But that is absolutely qualifying income that she's doing. She's performing a service. But unfortunately, most babysitters don't file tax returns, so she would need to be paying taxes on that income, and then she could certainly open a Roth IRA with those funds. That is absolutely doable. Gary asks, when I withdraw on my Roth IRA contributions, not the earnings, prior to 59.5, the withdrawals will be 100% penalty free without proration, correct? So the cool thing about a Roth IRA, all of your contributions to a Roth IRA are considered full basis, meaning you can access your contributions at any time, tax and penalty free. Now, think about your Roth IRA kind of like a target being struck by an arrow. There's a few different layers. There's the target, there's the hay bale, and then there's something behind it. So the target, when you first hit, is going to take your contributions, tax and penalty free. Then the next pool it will get into is any converted amount. So long as those have been converted for at least 5 years, those are going to be tax and penalty free no matter what your age. And then finally, the last thing that you'll hit with that arrow when you're distributing out of a Roth IRA is earnings. That's when you have to be 59.5 and you have to have the account open for at least 5 years in order to take those earnings out tax and penalty free. And those earnings can be attributable to either your basis of contributions or your conversions, but you have to just make sure that you keep track of how much earnings you have in that account, because everything that's not earnings can always be distributed tax and penalty free. Can tax associated with the conversion be paid outside of the IRA? It has to be. You do not pay for the taxes on a conversion with funds within the IRA. That would be a real downer if you had to do that. So yeah, you're personally paying taxes because you're showing an additional increase in income for that given year. Let's see, you referred to, yeah, so with Gary, I'll get into that in a minute. That's a little bit more complicated when people start talking about mega Roths and 401ks. Um, yes, let's see. Okay, we only have 2 more, that's not too bad. If I make a non-deductible contribution to a traditional IRA and convert to a Roth, will I pay taxes on the conversion? If you don't do the correct tax filing, William, you will. You need to make sure you're filing Form 8606 for tracking non-deductible IRA basis contributions in between those 2 IRAs, so you don't get hit with a double taxation. But a lot of people don't do that, and I see people getting hit twice on showing that they had a non-deductible traditional IRA contribution and then are claiming an additional amount of income on the conversion. You have to make sure you file 8606 to not have to pay additional tax on that. And then last question before we get back into this, can you convert a rollover IRA? Yeah, James, a rollover IRA, all it is just a trade name for a traditional IRA. It was coined by Fidelity just for marketing purposes. Really, there is no such thing as a rollover IRA. It's just what companies call them. It's just a traditional IRA, and you can absolutely convert that to a Roth IRA. There's not a problem with that. All right, I see some other questions filing in, but we'll get back to this so we don't get too far off the beaten path. But if you do type in questions, I'll get to those in a few moments. So for a Roth IRA, you have a 10% early withdrawal penalty if under the age of 59.5 for your earnings. So if you're taking out earnings before then you have to look at that penalty. You can always access contributions tax and penalty free at any time because it is considered basis. If you do a conversion, that has to be aged for at least 5 years before you can treat that as basis as well. Then you have tax-free income after the age of 59.5. So everything after the age of 59.5 is completely tax and penalty free. Now you can get rid of the early distribution 10% taxable penalty if you have a few things. For higher education expenses, disability, if you're a first-time home buyer, and for inherited Roth IRAs, you do not have an early distribution 10% assessed to that. And we already went into the contribution rules. Essentially, it's just using the principles of FIFO, first in, first out, for distributions when looking at for looking at that. And also keep in mind that conversions you do have to track as well. So if you have multiple conversions over multiple years, you're going to have to track and see how long that those have aged, because remember, each one's going to have its own 5-year aging period before it's considered basis within that account. So some people ask, why would I do this if I'm just claiming on having to pay more taxes in a given year, which a lot of people do. They say, hey, you know, it's great. I don't have to pay, I get deductions. I don't have to pay additional taxes. Well, especially with the doubling of the standard deduction that we had under the recent administration's tax law changes. I came through with the, I believe it was called the name of the bill was the Secure Act. It doubled the standard deduction for individuals and married households across the board. So people have a lot more wiggle room with their amount of deduction that they can take and amount of income that they can offset in a given year relatively easily. So being able to do a Roth conversion is getting a little bit more attractive. But there are some other reasons that you might want to do it as well. If you expect large returns on the investment in future years, being able to pay the taxes on that now at a present lower value and then not have to pay any taxes on the high levels of income that you would potentially receive later on down the road is a really attractive benefit. If you have a long time before retirement, you're definitely going to always have lower tax rates. You're going to be earning funds for a lot longer, and the compounding interest on funds that you never have to pay tax on really has a great snowballing effect the longer that you do it. And what we saw a lot during the 2006, 7, and 8 years with depressed real estate values, we had a lot of clients do Roth conversions at that point when we saw historic drops in real estate value. They didn't get rid of their real estate. They realized it was an opportunity to take those assets that were at that point maybe half of their original value or 3/4 of their original value or just a quarter of their original value, pay taxes on it then, and then all the appreciable gain, growth, and anything from maybe the sale of the property down the road or the increase in rental income that they got would never be taxed again in the future. And for estate planning reasons, if you don't want to leave a large taxable burden to your heirs, a Roth IRA is a really good way to be able to do that by being able to leave them assets that are not going to have to be taxed within their lifetime. Now, converting to a Roth IRA doesn't always make sense for everyone. There are reasons that you wouldn't necessarily want to do it. If you are closer to retirement and you're not necessarily expecting any larger growth in your asset value, or maybe you're getting close to retirement and you're going to have to be on a fixed income, having a very large tax bill right before you take on retirement when you're going to be on a much more fixed income could also maybe not make sense for the tax filer as well. You will be in a much lower tax bracket in retirement. So the effective tax rate that you might be paying on the traditional funds that you'd be taking out, so the incremental $3,000 or $5,000 that you maybe would take out a month or every quarter from a traditional IRA or a 401k would be taxed at a significantly lower rate than if you did it now when you're a significantly higher wage earner. And the delta between your benefit of paying a larger amount of taxes and the incremental small amount of taxes between a conversion and a traditional IRA in retirement may not make sense if you're doing that a little bit later on in life. A lot of people will utilize Roth conversions when they're maybe a little bit younger, and younger is a relative term. So individuals we see doing a lot of Roth conversions are a lot of the times between the ages of 20 to 60. I don't see a lot of my actually retired clients that are not still actually working doing Roth conversions. Not to say that they aren't, not to say that there isn't a valid strategy for doing so, but just keep in mind that there are some reasons that you may not always make it a good deal for you to do a Roth conversion. If you don't have the available cash to pay the taxes on the conversion, the last thing you want to do is be taking tax qualified money to pay for a tax bill that you incurred because of this election you made on doing a Roth conversion. So just keep that in mind as well, that you absolutely have to pay the taxes personally on the Roth conversion. It's not paid out of the funds that you have within that account. And also, if you want to access the funds within the next 5 years, remember, it takes 5 years for a converted for a Roth conversion to reach the status of basis, meaning that it is tax and penalty free with irregard of your age. So if you needed to have access to those funds and you're under the age of 59 and a half and you did a Roth conversion, you can't touch those personally without a 10% early withdrawal tax until that 5-year aging period has elapsed. Now, it's not 5 years counted from the day. If you establish a Roth IRA or do a conversion before December 31st of this given year, you get credit for a whole 365 days in this year. So it's not like you have to look at the exact calendar date that you performed a transaction. If you open a Roth IRA and do a conversion or some other type of event that would need a 5-year clock to start for it, you get credit for the entire year, irregardless of which date that you actually open the plan. Okay, we're going to get into the mechanisms here in a moment, but let's answer some questions. All right, Cheryl asks, could you address if a 1099 from a partnership would be considered earned income? That really depends, typically not if it's just 1099 income with no withholding taken out. It's also going to depend on whether or not that you are claiming that 1099 income as for services rendered, or if it's for passive income coming to you from like an interest or a royalty or something. So it depends on which dash code of that 1099 and where you are claiming that income, on your personal tax return. Do I still have to track the 5-year period if I'm over 59 and a half to avoid penalties? So yeah, you still have to track the Roth conversion that you do over 59 and a half. Any earnings are still going to be tax and penalty free. But if you have not established the account before the age of 59 and a half, you still have to do the 5-year tracking for that. So if you're starting your Roth IRA with a Roth conversion at the age of 59 and a half or older, you still have to track that. If not, then no, you don't have to track it. So how do you prove that the contributions have been in the Roth for 5 years? Well, remember, it's the conversion that has to age for 5 years, and the account in total has to be at least 5 years old for certain aspects. But if you're just talking about taking a distribution of basis, it's part of your 1040 in one of the schedules when you say that you took money out, because you'll get a 1099 for it, and then the issuer, sometimes if it's a small enough issuer, can issue it with a known exception. Typically, they may not issue it with any known exception, and then you have to file for your exception from that by indicating that it was basis that you had taken out of that account. If I convert publicly traded stock from my traditional IRA to a Roth, do I have to keep those specific stocks for 5 years? No, you do not. You can sell it. It's just a matter of when you want to take money out, you can buy, sell, and trade those assets. It's just a total amount of value that you're looking at from that perspective. Let's see, pass-through income reported on K1 for an S Corp in which you are the owner shareholder should be earning income eligible to be considered an IRA contribution, correct? Honestly, don't. I am not confident enough in my knowledge on that answer to give you a yes or no, so I would defer you to a tax advisor for that specific question. Again, it's not something I feel comfortable answering definitively and having you make a decision based on something I say. So I would refer you to tax with regard to the pass-through K1 and an S Corp situation, just to make sure that you are doing things correctly and on the level. So in order to do a conversion, what do you need? Now, if it's cash, it's easy enough. It's dollar for dollar. Tradable securities, you look at the stock exchange, it gives you an exact value, you convert it. Now, for our clients and the people listening in here today, you're probably going to be looking at different things, maybe things like real estate or private stock or limited partnerships. Things that don't have a readily assessed value or are hard to value. So you'll need to have an independent third party and documentation for the transference of that ownership. Because when you convert to a Roth IRA, you're actually changing the titled ownership of that asset from the traditional IRA, which is its own separate entity from a Roth IRA. You certainly are the grantor, you own those accounts, but the accounts themselves are entities recognized by the IRS that actually can hold title to assets. If you were to look at a deed for a piece of real estate owned by an IRA, it would read Advanta IRA, FBO, IRA, and the account number. So actually these things, if you are converting from a traditional IRA that has a piece of real estate to a Roth IRA and you want to move that real estate over, you're going to have to get a quitclaim deed to change the name on that deed to convey the ownership from the traditional to the Roth. You would have to get some type of assignment of membership units for an LLC. You would have to contact the limited partnership that you might be invested in to reissue the shares in that LP to the name of the Roth IRA. So there's definitely a little bit more legwork that has to be done for that. And qualified market value is also something that comes up because there's a lot of different things that may espouse to be the value or have a particular value for a specific asset. Now, this could be something like a tax bill. This could be something like, and I'm referring to real estate, or something maybe like a website like Zillow or a comparative market analysis. Those really aren't considered meeting the threshold of clear, independent, certified valuation that you need for this, because keep in mind, this is a taxable event. And if you were to be audited, it would ultimately come down and then the valuation would have to be defended. And you really need to have someone that is qualified or licensed in some cases to make a valuation of a piece of an asset that you hold in the IRA. And it has to be a clear, independent third party. So it can't necessarily be the limited partner of a partnership giving you your fair market valuation to do a conversion. You need to have it looked at by someone like a CPA, an attorney, a firm that specializes in valuations, but someone that is willing to put their name to it, and a legal defense that you feel comfortable could defend the valuation that is being provided, because that directly correlates to how much tax you pay. You know, if something is significantly undervalued incorrectly, that could cause a lot of issues for you down the road. And for any type of valuation that we're doing for Roth conversion, it is only good for 30 days. So especially if you're looking to do a conversion and split your liability over 2 taxable years, such as you can do in this coming month, keep in mind that that valuation needs to be dated with enough time for it to be valid into the new year. So that's 30 calendar days, not necessarily just 30 days in a given year. So you have to make sure that that rolling 30-day period is calculated if you're trying to do something within this year and split it into next year. So some acceptable options. Real estate must have an appraisal by a qualified real estate appraiser, not a comparative market analysis. A promissory note would be the outstanding principal plus any unpaid interest. Notes are a little bit easier to value, so long as that they are current. You know, if they are behind on payments or the note is expired and it's still not paid off and there's been no note modification, then you might need to have a third party come in and look at it. So for LLCs, corporations, and partnerships, if they're not independent, then you'll need to have an independent party look at those valuations. So if they are managed in-house, then that would need to be looked at because you would need to get a clear independent third party. And if you have something else, something different, give us a call. We'll walk you through the process and tell you exactly what you need in order to make sure that you get your valuations done correctly. So to convert or not to convert. Now, I see some questions rolling in. I'm going to get through the slides because there's not too many left. And then at the end, I will address the questions that I haven't gotten to yet. So there's pros and cons, obviously, for anything when it comes to doing a financial transactions. Everyone's situation is unique. There's no conversion calculators, there are conversion calculators to assist in your assessment of how much tax you would actually pay. Again, I can't do that calculation because I don't know your personal effective tax rate. It can change wildly. It can also change with regard to what states you live in. And we're also not tax advisors, so it's not a service I could provide. So there are plenty of places out there that will give you a rough, good estimate of what your liability personally would be for a Roth conversion. Your age and your projected returns are probably the two most important factors. One thing that's left out of this slide, I would also add in that your personal ability to pay that tax liability is also a very important factor. If you're heavily invested and don't have a very strong cash position personally, and you have a large tax bill, well, how are you going to pay that? You might have to kind of scramble, or forbid that you'd have to take something out of the IRA in order to pay a tax bill would be a really unfortunate situation. So keep that in mind. You do have the ability to split your tax bill. Again, if you want to do the valuation and convert a portion of an asset, and I've done this with pieces of real estate, I've done this with LLCs, private stock, where we will perform a portion of the conversion the last week in December, and then after the 1st of January, we'll do the other portion of the conversion, effectively splitting your tax bill over 2 years and converting the entirety of what you were planning on within the span of maybe 3 or 4 business days. And just keep in mind that there is no such thing as a previous year Roth conversion. If you want to do this, you're going to have to do it by December 31st in order to have anything counted on 2020's tax bill. All right, so let's go to some questions. That's the end of the slides on the presentation. So if anyone wants to dip out, I will stick around as long as people are asking questions. So let me scroll up. I know there was one with regard to what people like to call mega Roth contributions. Okay. So the backdoor Roth is what a lot of people like to refer to as making a contribution to a traditional and converting it to a Roth. It's easy enough to do if you make over the modified adjusted gross income limits for directly contributing. Just make sure that you're tracking that non-deductible basis from that traditional IRA with Form 8606. Get with the tax advisor, make sure you're doing that correctly. Now, people also like to refer to the provision of what is called a mega Roth IRA, a mega Roth contribution, using a solo 401k in where you are able to make up the difference of the employer match to your employer match to your elective deferral of income on a non-deductible basis in the 401k. You can bring it up to that limit. It's a little bit kind of hard to explain without some actual graphical interface in front of me, but we do have a few classes on it. And if you want some more information, give me a call. I can kind of type up an email, and I think we might have some other materials on that. But there is no restriction for doing that. And part of the question is, can you do that the following year? For any of that, those types of contributions have to be made by the end of the pay cycle into the next year. So you would really need to do that by the 1st or 2nd week in January for the mega Roth contributions for 401ks. Okay, let's see. When converting tax-deferred IRA assets consisting of stocks and mutual funds to a Roth IRA, must the stocks and mutual funds first be liquidated to cash? No, I think I already answered that one. That does not have to be done. And can you undo a Roth conversion or a portion of it? Unfortunately not. That was stricken from the tax code back in 2017. You used to be able to do a recharacterization of Roth conversions up until your filing date. You can no longer do that. So if you do one, you might be able to undo it in a given year if you can work with your custodian, if there is any way to back out of it. But when the clock strikes midnight on December 31st and it becomes January 1st, you are stuck in that conversion. It is permanent at that point. So there is no way to do it anymore. There used to be, but the IRS got rid of that provision. Joe, okay, so if some previous IRA contributions were post-tax and some pre-tax and post-tax, yeah, you can, Joe, you can absolutely do that. You can convert, if you have commingled 401k contributions, you can absolutely convert the post-tax ones, or the pre-tax to post-tax. You just have to make sure that you have properly tracked your contributions in that plan if it's like a solo 401k. But yeah, if you have a mixture of both, you can do in-plan Roth conversions. That's not a problem. Let's see, Andrea asked, does this apply to Roth solo 401k conversions? Yes, any conversion of assets from pre to post tax has to be done by December 31st of a given year for any of that to be counted on that given year's tax return. There's no like certain portions of the time during the year that you can, like, you're open to do it. It just has to be done to be counted on that particular tax year by that date. If I do the conversion, Javier asks, if I do the conversion on 12/31, do I have to pay the tax the same day? No, you don't have to pay the tax the same day. You just pay the tax by your filing deadline, plus any extensions. Let's see. Salil, I sold my properties and want to convert from traditional to Roth. My properties were in a traditional IRA. Can I do a 50% conversion on 12/31 and 50% on January 1? Absolutely. You can certainly do that to split your liability across 2 years. And how does the tax rate for each 50% apply? It's going to be whatever your effective tax rate is. So whatever your modified adjusted gross income is, your MAGI is for a given year, you will just adjust that number up by the amount of the conversion that you did in that given year. So if it was $100,000, you'd just be showing an additional $100,000 of earned income for a given year, and all of your deductions and credits would help whittle that down, and whatever effective tax rate that would land you in, which could potentially be a higher tax rate, is what you would pay. Yeah, you can certainly transfer to the same Roth. That's not a problem. All right, well, if it doesn't look like we have any other questions and we got people filing out pretty steadily, I'll go ahead and end it there. Thank you very much, everyone, for joining us today. I enjoy putting on these presentations. I hope everyone got something useful out of it. And if you have any questions, my contact information has been up there for a minute, so feel free to give me a call or shoot me an email, and we'll get you taken care of. I hope everyone has a wonderful end of their year, finish everything out strong, and please let us know how we can help you going forward. Thanks.